Hi, William. Thank you so much for joining us today.
Oh, it's a pleasure to be here. It's always good to see you, and certainly some interesting things to talk about.
Gold and silver have rebounded after a sharp pullback from record highs. From your perspective, was the earlier sell-off primarily a technical correction, or did it actually reflect a meaningful shift in market fundamentals?
Well, there were several things that converged at one time. First of all, the positioning in the market was very overcrowded. We had a lot of late buying come in and rush, and usually you'll see that in a parabolic move, especially in silver. Was really a momentum-driven run. And when prices overextend, particularly at record highs, the market, any market becomes hypersensitive to any type of catalyst. So fundamentally, I really don't like to pay a whole lot of attention to, but you have to. There was a repricing in rates and dollar, and also in the dollar, and expectations around U.S. monetary policy shifted a bit. There were also some changes in the Chinese market. The Chinese market, we saw very large rise in margins. One of my sources told me that the Shanghai Gold Exchange was putting 50% margins on their T plus D contract. And she also told me that, and she's in the brokerage business over there, works for a broker, and said that a lot of the futures accounts at the Shanghai Futures Exchange in metals were liquidated or frozen. So when that stuff happens, you shake out a lot of the people who typically have to be long. So I think you saw the weak hands coming out of the market, and that, along with expectations about U.S. interest rates and the dollar, gold reacted and silver reacted immediately.
Markets reacted swiftly to Kevin Walsh's nomination, with the US dollar strengthening and gold pulling back. So do you view this as a short-term repricing of policy expectations? Or could it mark a more durable shift in how markets are actually discounting the Federal Reserve's future path?
Well, I think you framed it the right way. It's more of a repricing rather than, what some people are looking at as a regime change, say, over there. Warsh is perceived as fiscally and monetarily conservative. So I think the markets may have adjusted expectations in a very quick way. And so stronger dollar, firmer real rates, and maybe less tolerance for inflation. That in the short run causes headwinds for gold just from the knee-jerk reaction you get off of the news. But this one nomination it doesn't get rid of the structural debt issues or long-term currency concerns. To become a durable shift, you need to have consistent follow-through, in policy, not just personnel. So while he's been historically orthodox on inflation and balance sheet excesses, the issue is, in a Trump environment where there's jawboning for lower rates and it's explicit and relentless, it's going to create an interesting tension. Fed chairs focused on credibility may ultimately choose accommodation if the political pressure becomes intense enough. And if you get lower inflation data, it might give some modest cover for that. So, those are like two competing interpretations. But as a trader, I keep my eye on the price structure and how prices react to any shift in policy or news, because that'll tell you if the market is priced in the event. Often if say bullish news comes out and a market doesn't do anything or starts to go down, that might tell you that the market has already digested the eventuality and probability of the event. But I think in the current event, in the current thing, it's the volatility that occurred with the exuberance that was in the market is what's caused these moves that we've had.
Silver has underperformed gold both on the way down and in the rebounded. So how much of that divergence is due to silver's greater industrial exposure? And how much reflects speculative positioning being unwound?
Well, silver, it's interesting. It's two different factors in there. Silver is doing what it always does. The moves are amplified as compared to gold. And the biggest driver of these excesses are speculative positioning. Silver can attract some fast money, particularly late in the rallies. And when that money unwinds, the move is violent. Gold still is viewed as largely as a reserve and macro hedge. Silver is far more cyclical and the leverage to sentiment. So the thing that struck me was yesterday when I looked at the implied volatility of silver, it was up to around 115%. It's crazy. Gold was also pretty high, around 35%. Silver today is around 85, which is still extremely high. So these movements are going to be more in absolute terms, considering the all-time high prices we've seen. But however, I think the latest move down, silver held at the bottom of the range of a congested area. So now the key for short-term traders is to see how it reacts to key retracement numbers as it tries to rally, which it's trying to do now. And that's why looking at price structure to identify support, resistance, and where you might see accumulation and distribution. If you're looking at the price charts and numbers, you actually have something objective to measure. And so that's what I'm looking at right now. And I'm not surprised at what it's doing. It's all in fast motion because of the volatility in the markets. And but I look for things that are measurable rather than subjective.
As precious metals stabilize, which signals matter most at this moment? Is that real interest rates, dollar momentum, Federal Reserve's communication, or geopolitical risk? And which do you think the market is actually right now mispricing?
Well, in these markets now, because so many people have access to the markets than ever before. Before it was a small community of people who traded gold and silver 25 years ago. And since 2003, when the ETFs happened, were developed, that securitized gold. So what does that mean? It means that asset managers now can put gold in their investment portfolios for people since then, when commodities had been precluded from doing that. So these ETFs have opened up a whole investor universe, and that had been the driver, particularly for gold. Silver's a little different because of its industrial use, but gold has been driven strictly by investment demand from 2003 until just recently, and then the central bank buying came in to actually amplify the demand over there. And then as well as now you can see people all over the world accessing markets that were pretty much confined to a smaller universe of people. I think from an economic and a macro look at it, things that would economically drive it, again, real interest rates, the US dollar are pretty much at the top of the list, since gold is usually priced in dollars. Any reaction in the dollar is going to have the same type of reaction in gold for the most part. If real yields keep rising, I think precious metals might struggle a bit regardless of geopolitics, but I don't think that's going to happen. And also, human nature has us put more emphasis on data that might support a bias. Okay, so we see people that saying, well, gold should be at $6,000. So what are you going to pay attention to? If you have this type of data, whether it's interest rates or things like that, you'll always find something that can pin that'll support your bias, and you may disregard other news that might not support your bias. So I prefer to look at prices, because prices give me objective measurements and create an overall more objective and unemotional view. It also disciplines you into listening to what the market's telling you, rather than you telling the market what it should do. And I've seen a lot of people lose a lot of money because the market wasn't doing what they told the market it should do. So believe me, the market doesn't care about what any of us think.
Finally, for long-term investors, does this pullback and rebound phase look more like a healthy consolidation within a secular bull market, or does gold require a new market catalyst to regain sustained upside momentum.
Yeah, it was an opportunity. And as I said, I was looking for areas and it got there a lot quicker. And that's the type of thing I would look for buying opportunities if I wanted to add on to positions. But for long-term investors, and I think gold is more suitable as an investment vehicle. But the pullback can be an opportunity to add on, especially if people have a balanced percentage of gold in portfolios. You ostensibly dollar average in that case. So again, investing and trading are two different things. And as the market goes down and you're adjusting your portfolio, let's say you have 15% of your wealth in gold. As the gold price goes down and you readjust your portfolio, you're going to be buying more gold and you might be selling some of the stuff that's outperforming and vice versa. I think rather than have an immediate rebound all the way back up, I think the market it's like you dropped a rubber ball from a really high. You threw it way up in the air and it came down. It's going to bounce back up higher, and then it's finally going to settle down. But it's not a close your eyes and buy everything moment. And the other thing I saw last night in China was huge buying in silver ETFs. So I think that's helped the silver market as well today. But again, if you're trading, you can play both sides of the market, and volatility will create opportunities and risk. But as an investment, I think it's a good idea to have some gold as a neutral to negatively correlated asset class in your portfolio, and look at the price as a percentage of your portfolio as opposed to being influenced by the level of the price.